Have you ever imagined a system where you lend money to the government and instead of earning interest, you have to pay to lend it? It sounds absurd, but this has already happened. And it's still happening. They say it's to stimulate the economy. But the truth is, this is one of the biggest financial scams in history. Now imagine that the money you save in the bank simply disappears over time, even if you don't spend a single cent. What if instead of being rewarded for saving, you were punished? It sounds crazy, but this is the reality of negative interest rates, and this is just the tip of the iceberg. Since the 2008 crisis, central banks have been printing money with no control. They call it quantitative easing, but in practice, it means creating money out of thin air, destroying your purchasing power day by day. What happens when more money enters the system without creating more wealth? The value of money plummets. Your work is worth less. Your assets dissolve. And in the end, you become a hostage to a system designed to enrich banks and governments, while you slowly lose everything. But what if I told you this manipulation goes far beyond your wallet? Runaway inflation and currency destruction erode the moral fabric of a society. Less incentive to work, strive, and save, and more encouragement of reckless consumerism, victimhood, and opportunism. The Romans did this and destroyed their empire. Now history is repeating itself. In this video, I'll show you how negative interest rates work, who really profits from this fraud, and most importantly, how you can protect yourself from this financial scam happening right before your eyes. Negative interest rates, a concept that defies traditional financial logic. In a normal system, when you lend money, you expect to receive a higher return in the future. After all, lending involves risk and time, and interest exists precisely to compensate for that. But with negative interest rates, the opposite happens. The interest rate is below zero. In other words, instead of being rewarded for lending, you pay to lend money. The official argument? To stimulate the economy. With negative interest rates, keeping money in the bank becomes a bad deal, pushing people and businesses to spend and invest more. It sounds like a brilliant solution, but there's a problem. This logic completely ignores the real purpose of interest, to balance time and risk in the financial system. When you artificially remove that balance, you create dangerous distortions. Think of it this way. It's as if you lent $1,000 to a bank, and at the end of the term, got back only $990. Or worse, as if you deposited your money and instead of earning interest, saw your balance shrink month after month. And the consequences go beyond your bank account. Negative interest rates destroy the wealth of honest savers. Those who save money are punished. Those who take on debt are rewarded. The result? A system where saving, hard work, and effort lose value, while reckless consumption, speculation, and opportunism are encouraged. This leads to an even more serious consequence. The dilution of money results in the dilution of morality. When the economic system itself pushes people to spend everything they have, long-term thinking disappears. Effort and discipline are replaced by dependency and submission. Now let's look at the numbers. Have you ever heard of real interest rates? Real interest rates are simply the nominal interest rate minus inflation. If inflation is higher than the interest rate, the real rate is negative, meaning your money loses value even when invested. Want an example? In Argentina, in 2022, the official interest rate was 70%. Sounds high, right? But real inflation was 83%. That means the real interest rate was minus 13% per year. The result? Investors in those bonds lost money because real inflation was far greater than the official figures suggested. But why don't these numbers add up? Simple. Inflation indexes are manipulated. Write in the comments if you think the government is telling the truth about inflation. The government uses controlled metrics to mask currency devaluation. But as Ludwig von Mises explained in 6 lessons, real inflation isn't measured by rising prices. It's measured by the expansion of the money supply or how much money was created or printed. In Argentina, for example, between 2020 and 2022, the money supply grew by more than 200%. That means any interest rate below that level was an absolute loss for anyone keeping their money in the traditional financial system. Negative interest rates are not just an economic theory, they have already been implemented in various parts of the world, always with disastrous consequences. In Japan, negative interest rates were used in the 1990s and again in 2016. The Bank of Japan believed this policy would stimulate consumption and investment, but the opposite happened. Economic growth remained weak and government debt skyrocketed. In Europe, the European Central Bank adopted negative interest rates in 2014 in an attempt to reverse the damage from the 2008 financial crisis. Countries like Switzerland, Denmark, and Germany also implemented this policy, especially in government bonds. In practice, investors ended up paying to lend money to governments. But what were the results? First, the explosion of asset bubbles. With negative interest rates making saving a bad deal, investors were forced to seek alternatives. Money flowed into stocks, real estate, and even cryptocurrencies, artificially inflating asset prices. Second, the devaluation of government-issued money. When governments impose negative interest rates, inflation erodes the purchasing power of the currency. At the same time, this mechanism reduces the real burden of government debt. The result? Citizens lose while the state benefits. Third, the total disincentive to save. If idle money loses value, saving becomes irrational. People start spending recklessly, driven by the fear that their money will be worth less tomorrow. And finally, the biggest beneficiary, the government itself. With negative interest rates, it can borrow more cheaply, shifting the burden onto the population. Banks also profit, as negative rates push people into riskier investments that keep them tied to the financial system. But how did all of this start? The turning point was the 2008 subprime crisis. When the US housing market collapsed, central banks opted for an extreme solution: quantitative easing, essentially printing unprecedented amounts of money. This led to the manipulation of the most important price in the economy: interest rates. Instead of allowing the market to correct excesses and letting inefficient companies fail, governments injected trillions of dollars to bail out banks and large corporations. The result? Social inequality exploded. While the general population suffered from inflation, the wealthy saw their assets skyrocket in value. The economy became increasingly dependent on artificial stimulus, creating the illusion of growth. And, as Friedrich Hayek predicted in The Road to Serfdom, the financial system became unsustainable. The more governments interfere in the economy, the more distortions they create, leading to deeper and more frequent crises. This has happened before. The Romans also destroyed their own currency over the centuries, devaluing the denarius until it became practically worthless. And as history has shown, when money loses its value, the empire collapses soon after. Negative interest rates are not just an economic policy. They are a carefully planned financial scam. And like any scam, there are clear beneficiaries. The first big winner in this fraud is indebted governments. With negative interest rates, they can keep printing unlimited amounts of money and borrowing without paying practically anything. Public debt keeps growing, but the cost of financing it disappears, while the population foots the bill through inflation and loss of purchasing power. Next, we have central banks, which use this tool to manipulate the economy artificially. When money is forced to circulate, central banks maintain full control over financial markets, deciding which sectors thrive and which collapse. And of course, large corporations and institutional investors profit the most. With negative interest rates, they can borrow money for free, leverage their operations, and inflate their profits even further. Meanwhile, the average person watches their savings lose value and their cost of living rise. But this scam has an even deeper and more invisible consequence. It robs society of technological progress. In a healthy economy, technology naturally lowers prices. Innovation increases efficiency, and products tend to become more affordable over time. But when governments print money recklessly, this natural deflation is blocked. The excess money in the system prevents prices from dropping, keeping everything artificially expensive. What does this mean? That you are being denied a world where technology would make your life cheaper and more accessible. At its core, negative interest rates function as a hidden tax. You lose money without realizing it, while governments, central banks, and large investors continue expanding their power. Meanwhile, the average person works harder, saves less, and becomes increasingly dependent on a system designed to never benefit those who play by the rules. The traditional financial system is rotten, and negative interest rates are just a symptom of a much bigger disease. But the real question is, how can you protect yourself? Before we continue, please, if you are enjoying the video, give us a like and subscribe to the channel. The first thing you need to understand is that keeping large amounts of money in the traditional financial system is a terrible idea. With inflation and negative real interest rates, your purchasing power is being eroded without you even noticing. The solution? Move to scarce assets, gold, and most importantly, Bitcoin. Assets that cannot be artificially inflated, that preserve value in the long run, and that don't depend on the arbitrary decisions of a central bank. Some people talk about investing in real estate, but the problem is that you will be paying taxes to the same system that created this problem. One of the main disadvantages of investing in or holding physical gold is the difficulty of transporting it, especially when leaving a country. Carrying large amounts of gold can lead to legal issues, security risks, and logistical challenges. Additionally, there's always the need to verify the authenticity of the metal, which requires specific tests to ensure it is truly pure gold. These factors make gold less practical compared to digital or financial assets that are easier to move and verify. But investing alone isn't enough. You need to study decentralized alternatives and understand how financial systems work when they are beyond the reach of government manipulation. Financial freedom lies in decentralization, not in dependence on governments and banks. Now, imagine this scenario. What if Bitcoin survives another 10 years? That would mean a moral, material, and technological renaissance. In a system where money cannot be printed out of thin air, people would return to saving, investing responsibly, and creating real value. The incentives for reckless speculation and state manipulation would disappear. The economy would be driven by innovation and merit, not by artificially created distortions. What's happening today isn't just a financial crisis. It's a war between the state and financial freedom. The only question left is, which side are you on? Now the choice is in your hands. Most importantly, share this video with someone who needs to understand what's happening to the economy. The more people have access to this information, the weaker the system's power of manipulation becomes.